Good morning. You're watching the market right here on ET Now, and what all has happened, or rather, what not has happened since Friday when we last met up until now. But quickly tell you about what happened in the markets, and I guess that. On the weekend dinner tables, or for that matter, this morning coffee tables, would take perhaps a bit of a backseat. Having said that, the Nifty did manage to snap its three-day losing streak, and we did see that FIIs have turned net sellers after 16 straight sessions. It was a minuscule sell figure, but a sell figure regardless. IT, that's been gaining ground, and now for a fourth consecutive week, you've been seeing that IT has actually been seeing some buying at lower levels. And of course, globally, it's the debt limit concerns which continue to plague Wall Street. But I don't think it was about what the markets did, but that you have to now go back to the banks and change your 2000 notes, if you have any.
No, my phone was my phone was on silent between 5:30 and 6:30 on Friday, and here I open my phone and I see that world has changed suddenly in terms of the news flow. So
be it TCS or the 2K notes.
Sometimes you should not put your phone on silent. That's what the realization really has been for me. Okay, so what is the attempt here? That's what we understand. The attempt here is to look at global countries, and that's what the finance secretary also referred to, that look at all the global countries. None of the big global countries have very high note in circulation, whether it is the US dollar or whether it is the Great British Pound. So in India, the high denomination note had to go out. The number of notes, the number of 2000 rupee notes in the system are about 11%. This is not demonetization. There is a window in which the note would be accepted. B, if 50% of the total note, they go back into the system, it actually in the near term could have impact on the bank deposits. Banks in the short term are struggling because they are not getting a lot of deposits. So this could be a band-aid approach, but this could be a quick fix, but not a permanent fix. But yes, this is going to be an incremental uptick for banks where the notes would be deposited. See, the impact of the 2000 rupee note under circulation, they've come down dramatically. This 2000 rupee note was created post demonetization, but after that, UPI has happened. After that, the economy has become significant, has moved to significantly on the digital platform. The unorganized sector is also started using the digital platform. You had demonetization, you had COVID, you had UPI. So the nature of the economy per se is changed. And this is certainly not demonetization that the value of your currency or the value of your 2000 rupee note will go away. So it's not disruptive. It is something which definitely startled everybody and surprised everybody that why the government is moving. But I guess the finance secretary clearly said that the economy right now can absorb it. There is going to be no disruptive impact of this. And globally, everything in the locally the economy is moving from unorganized to organized and from currency to digital. And this is something where the time window, I think, is a very niche time window of more than 3 months.
Yeah, September 30th is the timeline that you have to withdraw the 2000 notes from circulation, exchange them or deposit them with bank accounts up until that date. Okay, that was clearly the big headline, but let's move away from that and focus in on the markets and how we wrapped up the trade on Friday's trading session. Yes, the print of 18,200 was intact as we held on to that, though we snapped that three-day losing streak, which was fairly encouraging. In fact, the weekly decline has been the most since the 19th of March. And the disappointing factor is that FIIs, after 16 straight sessions of buying, have turned net sellers. IT as a sector gained for 4 straight weeks on the trot, and the debt limit concerns, that is a big headline when it comes to Wall Street, a muted start on the SGX Nifty. So we snapped that three-day losing streak, but you did have FIIs, Nikunj, which turned net sellers.
So, Avan, you could look at the market from the prism of, okay, last week was not a positive week for the Nifty. Okay, last week FIs were net sellers on Friday. But for me, that's meaningless. And the reason why for me that is meaningless is because you cannot just look at 1 week's price action and assume something. B, the stocks from the mid and the small cap space, the stocks which are making a new high, I think that list is a very impressive one. The activity in the F&O market, if I look at stocks which are trading within the F&O market, it's an impressive list. So I will not read too much into last week's price action. I think Nifty is still above 18,000. Globally, you're not going to see market move in a straight line. I think we've consolidated enough. This week is the F&O expiry. If globally nothing goes wrong, and if markets get convinced that there is sincere progress on the debt ceiling front, that's going to be a that will give a spring in the stride for the bulls. So if globally things move, if globally if there is nothing wrong, looking at the local momentum, the fact that Nifty is consolidated, I guess this week in a sense could be an important week, and there is a serious case for Nifty to actually break out because of that expiry fillip. So for me, last week's price action, frankly, in the overall scheme of things is not that important, excepting that it just points out that right now markets perhaps are focusing on more mid and small cap stocks, and that really could be the trend for next 2-3 days as well.
Okay, this morning the SGX Nifty, much like all the global handover from Friday night, is indicating a very, very muted start. The SGX Nifty is lying absolutely flat with just a marginal negative downtake. There you go, around those 18,200 levels. But a lot of earnings as well to number crunch, and of course, key segment would be a Zomato and a delivery. We're going to be chatting with the management of delivery as well shortly on the show and get you an analysis on Zomato as well. But just looking at the scorecard for Zomato, it's largely, I would say, above estimates. Yes, the revenues have been a miss and haven't quite matched up with the market expectations, but both on the PAT as well as the EBITDA front, it is definitely a beat. In the conference call, Nikunj, them highlighting that growth, revenue, lower costs, all of it aided the profitability, and they continue to be bullish on the long-term outlook amid under-penetration. And they are saying that they will continue to make progress in the dining out business as well.
So Aisha, whatever they've committed or whatever they've committed in terms of reaching that profitability mark, I think they've managed to achieve in the core business, which is the food delivery business, a good 1 quarter ahead of what they actually had guided for. B, there is a decline in the GOP, but is that seasonal or that is something which is going to be a feature for this quarter as well? I think is the fly in the ointment. Now 2024, the way I look at things moving for Zomato is that will the Blinkit acquisition move in the right direction? Food delivery business already has consolidated. What could be the impact of ONDC, at least in the near term, for a food delivery company, and the dine out business where it moves? So you would say that 2024 for Zomato would be significantly different than 2022 and 23. The reason being that last year they had to digest the Blinkit acquisition. There was serious selling which came by anchor investors, and then the company in a sense had to change their internal strategy in terms of defining or redefining the path to profitability. So I think one thing is very clear, that Zomato is now committed to walk on the path of profitability. But in this entire journey where they are going to be walking towards the path of profitability, how will they ensure that the growth is not compromised? And the other two platforms which they've created, which is the Blinkit and the entire dine out experience and the Zomato Gold membership, what happens there? The differentiating factor for me between Swiggy and Zomato is that Zomato is going through a earnings upgrade cycle. Swiggy has just gone through a cycle of markdown. 3 markdowns have come for Swiggy. Largely, it's not a listed stock. So Zomato and Swiggy, they may be in the same business, but in terms of the market perception, one is going through markdown, other one is going through earnings upgrade. I think that's a very big difference.
Yeah, in fact, let's hear out what the Zomato management had to indicate in their conference call.
We've also mentioned in the letter that delivery cost has not changed much despite a lot of work we've done in the past because of various reasons. But going forward, we do expect that to change. So we're hoping that delivery cost, reduction in delivery cost will be more than what we've seen in the last year. And likewise, I think revenue should continue to increase. And we also expect our other variable cost to continue to come down as the efficiency in the business goes up in general, and also because of a little bit of operating leverage that we have in some of these things.
Okay, and the brokerages as well across the board giving Zomato a thumbs up. Morgan Stanley overweight, 74 rupee target price. Bank of America upgrading it to buy, 85 rupee target price. And you've got Goldman Sachs as well maintaining a buy, raising the target to 82 rupees. All right, Zomato aside, let's focus in on what is the global commentary. And clearly, the debt ceiling negotiations seem to be the key talking point. So my colleague Anisha Jain joins in to sum up all the global commentary. And primarily, it is focused focused on that very topic.
Oh, well, yes, it's 10 days to the D-Day for the U.S. economy because the U.S. debt default limit is coming due on June 1st. So the commentary is pretty much around that. Janet Yellen, the U.S. Treasury Secretary, also talked about what's happening with respect to that ceiling limit and said that if a negotiation is not really reached or an agreement is not reached, hard choices will have to be made. This is with respect to which bills will be paid and which bills will not be paid. And she says that if an agreement is not reached, there will be no acceptable outcome. So clearly, U.S. economy is staring at very hard choices going forward. In fact, the commentary coming in from the two parties, Joe Biden as well as McCarthy, was a bit wobbly over the weekend. Joe Biden clearly saying that most of what Republicans are proposing is simply, quite frankly, unacceptable at this point of time. He called out for Republicans that it's time to accept that there is no bipartisan deal to be made solely on their partisan terms. He says that I can't guarantee that they wouldn't force a default by doing something outrageous. So quite a bit of stark commentary coming in from the US President Joe Biden. Meantime, Kevin McCarthy also tweeted just 8 to 10 hours ago talking about the impending meeting with Joe Biden later today. But he says that their position has not changed. Washington cannot continue to spend money we do not have at the expense of children and grandchildren. So Republicans basically, standing a foot with respect to their ask that spending needs to be cut by the government going forward. Lastly, just wanted to point out was what the U.S. Fed Jerome Powell had to say, and a bit of a hint coming in with respect to pause. He says that the financial stability tools have helped to calm the conditions in the banking sector. Developments are contributing to tighter conditions, which is likely to weigh on economic growth, hiring and inflation. So as a result, our policy rates may not need to rise as much as it would have otherwise to achieve our goals. So pretty much as dovish can be.
Important commentary, and of course we will be watching out for how talks really progress on that front. Let's move right on then and hear it out from Ajay Srivastav of Dimensions Corporate Finance Service. He's invested in Dreamfolks, and he also believes that sectors like aviation and hotels look attractive.
I think we have reasonably invested in aggressive customer stories catering to the Cape market economy, as I mentioned to you, whether it's the airline lounge company, whether it's expensive watch company, whether it's airlines, whether it's hotels. I think India's story to us is restricted to that bit. And the large bit is the industrial companies. I think good or bad outcomes can be whatever it is. The capex plan of the government is giving major boost to all these companies. And if you've seen history over the 7-8 companies in the sector, doing wonderfully well, deleverage, good order book. So industrial capital goods is the second largest block of our investment at this point of time after this discretionary luxury products.
All right, now, as we walk into trade this morning, it's important for us to flag off that Asian markets are trading with a negative bias. SGX is trading flat with a downward bias, but Nifty, in a sense, really made a comeback and a smart comeback in the second half of trade. You could link it up with what happened to Adani Group of stocks, the fact that this is one large group where you see a bout of relief rally post 2 o'clock, and some of the stocks indirectly aided the market, and that also aided the Nifty. Kunal, are we in for a good week of trade, or this is going to be just one of those weeks where you just get kicked here and there?
No, I think the data still indicates that we should be in a 1% band at 18,200, on the index. And in fact, I was looking at, since this is the expiry week for the monthly series, most of the large cap names, the likes of HDFC Bank towards, even the likes of Reliance Industries, most of the banks, large cap names, they've actually started to see signs of option premium being written in the range of 1.2%, which means largely at the money strikes for these stocks. Traders are expecting that the monthly expiry would probably be at a range of 1% to 1.5% from the current levels. And if we do the same kind of analysis on the indices, it still indicates that we should be at a 1% to 1.5% band for the index. Also, if you look at the open interest data, no major change on Friday. On the OI for the Nifty and Bank Nifty, I think 2% reduction on the Nifty for the current month and 4.5% reduction on the Bank Nifty for the current month. And the most important part is that we tested 18,050 twice in the last 1 week, and we've managed to bounce back from those 18,050 levels, and we are back at 18,200 levels. So that also indicates that we should be fluctuating in the band of 18,200 plus or minus 150 odd points.
Naresh, hi, morning. You know, the trend that one has seen with the Nifty IT, and I'm going to talk about the Nifty in just a bit, but the fact that for 4 consecutive weeks, we've actually seen an uptick coming in and a rebound, you think that's sustainable?
So that's sustainable and that could be interesting given that fact. If you look at the larger names, we've not had any bounce as such. So Infosys continues to struggle at 1270. We've not seen a big bounce in TCS. We've not seen something in Tech Mahindra. The mid cap IT, the small cap IT has really rallied over the last 1 month or so. But the large cap IT names have continued to be at the same place or marginally up by a percentage or two. But if you look at what has happened in the US markets, Nasdaq 100 is up 33% from the bottom, and it's just down 16% from the top. And very clearly, the mega cap, say, tech names in the US have done really well. So out there, this creates a better sentiment. And on the other side, we are seeing USD INR coming back to that 83 mark, very close to it. So overall, the sentiment seems positive for IT. A short-term bounce is what I expect in the large cap IT names. So I would expect a bounce from here on of say 5 to 8% in the larger names like Infosys, TCS, HCL Tech, Tech Mahindra. So that's a trade for the short term. Whether it is sustainable beyond that 8-10% looks difficult as of now, but for now it can be played as a 8% bounce across the whole large cap IT names.
Let's find out what exactly the strategies are by way of individual stocks then. And Kunal, take us through your list.
So I'm betting on PSU Bank as well as a private sector name, and both strategies are a bit contrast. So first one for Bank of Baroda, the stock formed a bullish hammer pattern on Friday's trading session. Again, bounced off from its major supports of 175, 177 levels. So keeping 176.5 as a stop loss would suggest a buy with 190 as a near-term target for Bank of Baroda. And ICICI Bank is the other stock which is actually nearing a breakout about 950 plus mark. 947 approximately is where it closed on Friday. So expecting a breakout about 950 levels for ICICI Bank, targets of 980, stop loss remains at 920.
All right, let's find out what exactly Naresh as well has picked out this Monday morning. Naresh?
So first is the buy on Infosys. The stock has done nothing after the quarterly results. Stock took a sharp crack and now has been making a small base here. Expecting a bounce back in the whole IT names. The worst of the names has been Infosys over the last couple of months. So this could be a good bounce back trade, a risk reward trade, a strict stop loss at 1250 and a target price of 1340. Second is a buy on IndusInd Bank, which is setting up for a multi-year breakout. The stock pre-COVID used to be 1250, 1300. Over the last 3 years also, the stock has made multiple attempts around 1250, 300, 1300, and the stock came back to those levels now. Also, over the last couple of weeks, it is the first time it has started showing a relative strength to the Nifty as well as the Bank Nifty. This generally is an indication of a leadership move going forward. So expecting it to make a large move over the short to medium term compared to the banking space. A target price of 1500 and a stop loss at 1190.
Right. Okay, that's the take coming in from both Kunal and Naresh on what are the stocks that you can trade this morning. But lots on our plate this Monday morning, lots to discuss. For now, we're going to take a very quick break.
Welcome back, still tuned into the market. Well, let's put the spotlight on other news and developments over the weekend. And now come July, all stockbrokers have to display on their website the risk disclosures that are related to trading in the F&O or the futures and options segment. Some new F&O norms as well have been disclosed in the SEBI consultation paper, tweaks and rules regarding the upper as well as lower circuits. And this is basically to warn individual investors about the risks that are involved in derivatives trading. Joining in right now is Chandan Taparia from he's derivatives and technical analyst at Motilal Oswal. Chandan, just let's get in a sense from you as to what the outlook is on the tweaking of the rules regarding the upper and lower circuits and the cooling off period as well. If you can just elaborate what the new rule is in terms of now the new time frame from 15 minutes and what it would mean for traders.
Yeah, good morning. Thanks for having me. So recently the SEBI came out with consultation paper on price band formulas for script in equity derivative segment. So I'll focus on a couple of things here. First, the reason for this is for volatility management and minimize some lesser pricing. Special thing what I noticed in this proposal is that at the time of cooling period, even option premium gets swings. So as per this, when your future goes to the upper circuit, whatever the lock period time is there, that time even the option band or option should also be locked. So the proposal is that once script touches the price band is flexible, and after the cooling off period, even there will be a band in the option premium as well. So ultimately, aim is there should not be mispricing. There should be the tuning and trading in all the derivatives contracts, whether you talk about the future or underlying of the options. So the reason for this is how to control the volatility, how to control the misparity, which is happening. And I think because of this, the reason for even the freak trade will be reduced by looking at the circuit filter on upside and the lower side from this scenario.
So you're saying if it's a good thing if this is put to practice, right, Chandan?
Yes, exactly.
Okay, great to have you on the show. Thank you so much for that quick take coming in. That, of course, is the SEBI consultation paper, which also was announced over the weekend. Let's get back to earnings and lots of them to analyze. Zomato, we told you about it. Their loss has actually narrowed further in the fourth quarter. The food tech player remained adjusted EBITDA positive, excluding the quick commerce business or Blinkit. Let me take it across to Vinny and get in more details and understand the numbers a bit better. Vinny?
So in terms of numbers that have come out from Zomato, we are seeing that the revenue, the growth over there, slight bit muted in terms of a miss coming in from what the street was expecting. But profitability front, surely much better than that because losses are narrowing. Even the EBITDA losses, when you look at the operating performance, that has seen a bit of a narrowing coming in on a quarter-on-quarter basis as well. EBITDA losses came in at 225 crores versus an EBITDA loss of 366 crores last quarter. Losses 187 crores versus 346 crores last quarter. So considerable improvement in the profitability of the company. So that's one factor that the street is keeping an eye out on. Now overall, what the commentary is coming in from the business as well, what the management is highlighting, that business excluding quick commerce is adjusted EBITDA positive in Q4 FY23, and going forward in terms of target also what they're keeping, they're aiming to be positive both on the profit front as well as the adjusted EBITDA front on a consolidated basis in the next 4 quarters, within the next 4 quarters. So within 1 year, we could see that coming in for the company. Food delivery business, that adjusted EBITDA came in at 78 crores, which was better than what the street was expecting. Revenues saw a mild bit of a decline there, 1,530 crores versus 1,565 crores. That was mainly due to the demand slowdown that they witnessed in October to Jan. But since the month of February, they've started seeing green shoots coming in here and recovery coming in the food delivery business. Only the monthly transacting users, that saw a decline, but that was because of certain factors that were mentioned in the shareholder letter as well. Blinkit, when you look at it, that's seen a strong growth in terms of revenue as well. Hyperpop 2 is seeing a strong growth as well. So all in all, a good number coming in from Zomato, especially on the profitability front. And even Morgan Stanley maintaining an overweight rating, target price of 74 rupees. They see a strong outlook and profitability at a consolidated level, which is keeping them positive on the stock.
All right, thanks very much, Vinny, for those details. By the way, the stock price of Zomato wrapping up Friday's trading session at 64.5. We'll have to see how it reacts to its numbers this morning. But moving away from that, there's Divi's Labs as well. The pharma player came out with its numbers, and it was a beat on revenues as well as EBITDA. Let's get in Shrishti, who joins in with the highlights of Divi's Labs earnings. Shrishti?
So decent set being reported by Divi's Lab this time around, followed by a positive management commentary. Talking about the numbers, the company reported a top line of 1,951 crores, EBITDA as 488 crores, and sequentially we are seeing 100 basis point improvement in the EBITDA margin at 25%. The bottom line being reported at 321 crores, that's for almost a flat growth on a sequential basis. But if we look at the gross margins, they have actually improved 90 basis points sequentially at 57.6%. But on a YOY basis, there has been a major decline. And the company says that pre-COVID, they used to hold an inventory for 3 to 6 months. But now they are currently holding an inventory of 8 to 9 months. And that too, this inventory is at a higher cost. So going ahead in the near term, this high cost inventory is expected to impact them. But by the end of the financial year, they expect that the higher cost inventory should come down and the low cost inventory will help the margins of the company. On the other hand, the raw material prices are also coming down sequentially, is what the company highlighted. On to the business front, the custom synthesis and the big pharma projects are progressing well, and the commercial production of the sartans have already begun and should be visible into the numbers at Q1 of FY24. And for the full year, they expect the numbers to grow in the double digit. They also gave an update on their Kakinada plant, where by the end of calendar year 24, that should get operational with the phase 1. So all of these updates coming in on the positive side with a decent set by Divi's Lab.
Right, Shrishti, we'll leave it at that. And NTPC reported a mixed set of numbers for the fourth quarter. The top line was slightly weak. Anisha is here with all the analysis on their Q4 performance. Anisha?
Well, hi, yes. The overall quality of the earnings is quite decent, and if you look at the operational performance as well, that's pretty much okay. Yes, there was a bit of a miss on the top line, but that's pretty much made up as far as the bottom line beat is concerned. Now, in terms of the other internals, the generation was up around 7.6%, and that led to a revenue growth of 19% on a year-on-year basis. 44,000 thereabouts is what the company clocked in. The street was working with a number between 45 to 46,000 crore. Operationally speaking, the EBITDA performance was up 4.5%. And the net profit came in at 4,871 crores. In terms of the coal PLF as well, we have seen an inch up. 80.3% is what it was in the quarter gone by, and that compares with 76.2%. And that's also coming in on back of better availability. Remember, higher availability or plant availability factor means that the company gets higher incentives, and that's the reason we have seen higher other income come by. There was over recovery in the system as well. However, the company has taken higher provisions as well, and that's the reason you are seeing a bit of a blip on the bottom line. Overall, a decent set coming in from NTPC. But remember, there was another important commentary coming in with respect to the monetization of the renewable arm. Earlier, the company was targeting that March 2023 will be the time that they'll come out with the IPO of the renewable vertical. That clearly got delayed. For now, it seems like there's a bit of a pause, but they're maintaining that maybe later in the year, they'll relook at coming back with the monetization of the renewable vertical.
All right, thanks very much. Those are all the highlights from NTPC. Now let's move on. Several brokerages have changed their stance post the Q4 earnings outcome. Which companies have seen major upgrades and which are those that have seen major downgrades? Let's take it across then to Samit, who joins in with all the details. Samit?
Well, if you see on an overall basis, the Q4 earnings has been pretty much in line with what the street was expecting. However, a host of analysts have made stock-specific changes. Now, these changes in the target price could either be because of the March-ended quarter earnings performance or because of a change in outlook. Now, I'll start off with the list where the target price has been cut the most, and among the top 5, Aavas Financial tops the list with a 27% cut in target price pre and post the earnings has been announced. Now, if you see, the target price has been cut by analysts because the valuation multiples were cut due to resignation of the founder, which created uncertainty around the management transition going forward. So that's one of the reasons. For Jubilant Ingredient, again, the target price was cut by around 27%, and this was owing to the headwinds in the agrochemical along with margin pressure in the specialty chemical business. For United Spirits, due to a weak Q4 EBITDA and net profit owing to higher marketing spends, we had seen this cut in target price. For Gland Pharma specifically, if you see weak results owing to pricing pressure in the generics business, and company has also refrained from giving a guidance due to a volatility in the business, and because of both these factors, the target price has been cut by analysts. For Aditya Birla Asset Management Company, if you see lower operating profits driven by yield compression and likely industrial level cuts in total expense ratio led to this cut in the target price by the analyst. However, there are a host of stocks where the target price has also been hiked, and among the top 5, if you see, it's Wellspun India, which tops the list with around 35% hike in the target price. Now, analysts are saying that the improving demand visibility has led to this hike in target price. For Zenza Tech, it was a solid Q4 performance and expectations of solid earnings growth going forward, which led analysts to hike this target price. For Anupam Rasayan, if you see, the target price has been hiked owing to the recent order wins that the company announced along with the fourth quarter results. In Triveni Turbine specifically, if you see, the order book is at life high, while the strong revenue growth guidance of 35% given by the company has led to this hike in the target price by analysts. And for Sonata Software specifically, if you see, it was the strong fourth quarter numbers, the quant acquisition that the company announced, and the large deal ramp up led to this hike of around 25% of the when it comes to the target price.
Right. And Samit, tell us about what really is happening with FTSE in its quarterly review. I mean, what are the additions and the deletions which are made?
For the FTSE, if you see, the adjustment date is June 16, so still there's time away. But only 2 stocks have been included in the index, and that is the global health, that is Medanta and Piramal Pharma. Now analysts are expecting that because of this inclusion in the index, there could be inflows in the range of around 8 to 11 million US dollars, which is nearly 2.4 to 2.6 times its average daily volume. Apart from this, a host of stocks where we have seen an increase in weightage, and those are Solar Industries, Adani Transmission, Wipro, PNB, Samvardhana Motherson, Adani Enterprises, Godrej Properties, ONGC, and Varun Beverages. So keep an eye out for these stocks, because analysts are expecting that the inflows in these stocks could be in the range of around 5 million to 39 million US dollars, which highest coming in for Adani Enterprises around 39.1, but that is just 0.4 times its 20-day average volume. And for Wipro, if you see, the inflows are expected to be around 21 million US dollars, which is nearly 1 times its 20-day average volumes.
All right, thanks very much, Somit, for filling us in with all those details. Moving on, Union Bank as well in the spotlight with their management meet. B&K Securities has listed out some of the key takeaways from that meeting, where they have guided for credit growth between 10 to 12%. What are the other highlights? Harsh is here to break it down for us. Harsh?
Well, yes. So what we're looking at also is with regard to ECL, right? That's currently the main focus, especially when it comes to the PSU basket. There's some concern around that. So Union Bank has clarified that likely the impact or the hit of the ECL based provisioning norms will be a 2 to 2.5% hit on the capital adequacy. Largely, that is what they've guided for. Of course, a credit growth of 10 to 12% and a deposit growth of 8 to 10%. Currently, deposits coming back into focus and quite strongly. They're also confident of maintaining their FY24 NIMs in and around that 3% bracket. They are expecting Treasury to contribute a higher quantum in FY24 as rates seem to have peaked. Also, they are expecting a capital raise on the cards. Board has approved around 8,000 crore of capital raise as well. So that will spur growth, that will aid growth going forward. Also, with regard to the move to the new tax regime, they believe that there could be a one-time impact of around 1,300 crore on that particular count. That's broadly the key takeaways from that meet.
Amit Agrawal joins us, CFO with Delivery, and let's talk about the numbers and the performance for the quarter gone by. Amit, good morning. Thank you for joining us. Let's first understand that net loss for the quarter gone by has widened to 159 crore and revenues are also down 10%. Shouldn't it be the other way around, that revenue should be up and losses should be down?
Hi, good morning. As you are aware, we had a quarter-on-quarter improvement in our both revenue and profitability. Quarter one of this fiscal year was affected by the integration of Spot On with Delivery, which is well behind us. And from there, we continue to grow strongly on both revenue and profitability. Our profitability from quarter one of negative 217 crore of adjusted EBITDA has improved to plus 6 crore of adjusted EBITDA. And even on EBITDA basis, we are almost break even at minus 4 crore. The incremental margins in our business continues to be strong. And as the growth momentum continues, we expect to continue to improve on profitability.
Okay. So do you think that now that integration is behind, both in terms of where the economy is headed and where the business is headed, Q1 onwards, things would be significantly better?
We expect quarter one volumes to be actually strong. Generally, quarter one is a weak quarter of the year. This is something I had highlighted even a year ago, almost at this time. However, quarter one this year continues to be a strong quarter. And we are optimistic about servicing a larger and wider set of customers on back of superior service quality, which should deliver a good growth and hence improved profitability.
Right. Also wanted to understand, what exactly are you seeing in terms of levers that will propel the business going forward? What's happening with demand, for instance, on ground? Because what we're hearing from e-commerce companies is that there are only tailwinds in place.
Sure. See, e-commerce as a sector will see different experience for different set of companies, and individual players will see a very different impact. The good part for us is that we service, over 10,000 customers in e-commerce, from the best or the top e-commerce platforms to a large number of SME and long tail retailers. We service the whole bouquet of customers. And within this category, you will see different companies having different times ahead. The good part for us is that we service all of them. Overall, we expect the growth in e-commerce industry this year to be, slightly lower than what the medium-term, long-term average is. When we track our own record, we basically see, or industry record, when we track, overall industry has grown well over 35% year on year on a CAGR basis for last 5-6 years. And even if you were to lower it to 25-30% over next 5 years, that's a fairly healthy number. For this year, we believe the industry growth could be lower than that, maybe in range of about 15-20%. The important part or the good part for us is that that such difficult times are the times which really makes businesses make the right decisions. And this is the time when we would expect to, gain more share on back of superior quality and lower cost structure that we have. So because of this, we are very optimistic about the future.
Let's just look at the operational performance as well, because your adjusted EBITDA margin improved this time around. The incremental gross margins as well in the core express parcel and the PTL business that continue to remain above 50%. Do you think that this can be attributed to better network capacity utilization? And more importantly, what are the projections now on these parameters?
So this is the improvement in profitability is driven by a number of things. One is our tractor trailer strategy. We started inducting 46 feet tractor trailers into our network a few years ago. And these tractor trailers are more efficient on a cost per kg per kilometer basis. So as more and more tractor trailers get inducted into our network, we will see our middle mile costs going down. The second part is the utilization across the network continues to improve. Now, this is driven by proprietary algorithms which do capacity planning in various parts of the network, or in fact, all parts of the network they do. And the third part is that the synergy that delivery derives from multiple business lines. So, for example, we have been building the full truckload exchange separately, but last quarter was when we opened up the demand of deliveries trucking onto that platform, which allowed us to reduce our sourcing costs for our core business. So it's it's a combination of things which is leading to improvement in profitability.
All right. Appreciate your time then. Thanks so much for joining in and giving us a view on what your growth levers are and what the outlook is when it comes to delivery. Let's connect then with Sandeep Sabharwal, who's joining in on the fundamentals. Hi, Sandeep. And of course, we started off the show by saying what didn't happen over the weekend because there was a lot of news flow. But why don't we start off by getting in your take as to what the outlook has been when it comes to Zomato's earnings? Any key takeaways given the fact that it has been a healthy earnings roundup and you've got most of the brokerages across the board as well upping their target price and giving a thumbs up?
First, on the second point, I think brokerages have been giving thumbs up since the listing. So I don't think we should give so much importance to that. But I think that said, operationally, all these companies seem to be now pulling up their stocks and focusing on profitability. So despite the growth actually slowing down on the core business, the profitability has improved now, but they are still making losses and they are projecting to go into profits next year. So that's something we need to watch out for. But incremental news flow seems to be positive. I should have a positive rub-off on the stock price.
Sandeep, we put a lot of, yes and no kind of, mood behind us. 1 month ago, there were hardly any believers in the rally. Now everybody is convinced that the worst is behind us and the market is going to go to places. In general, where do you think the market trajectory is headed?
So I think markets will do well because globally still investors are quite scared. Positioning is low on equities. Even domestic mutual fund equity cash positions have moved up. The key global event to watch is how this entire US debt ceiling thing plays out, because the base case is that it will get resolved and they won't do anything foolish. But if anything happens, then it could create a sudden significant fall in all asset classes. So that's something we need to be wary of, but not be scared of. Everyone is expecting that sense will prevail, and that will not happen. So, given that that's not going to happen, overall, I think we are pretty well positioned, and market should see higher levels going up to maybe 19,000, 20,000 over the next few quarters in terms of the Nifty.
That's the view coming in. In the meantime, Sandeep, wanted to get in your thoughts as well on Siemens. The news on Friday really seemed to rattle investors, with the company planning to sell their low voltage motor business to the parent for about 2,200 crore rupees. A concern is that, governance concerns could arise on the fairness of valuation of the business being sold to the parent, and stocks like this and the likes of ABB, etc., may be overvalued with major motors exposure and high multiples. Your view?
Yeah, they are overvalued at this stage, and we've seen in case of Siemens and ABB several times over the last 2 decades of some business being sold, bought from the parent, sold from the parent, etc. So I think people had forgotten that, and then this suddenly come up. I don't know the nitty-gritties of it, whether it's positive or negative for the company, but I think short term it could create some concerns, especially at a time when these stocks are overvalued. The flip side is that the growth outlook for both these companies continues to be very strong. So I would think that if this creates a decent enough correction, then it could actually provide a buying opportunity rather than our taking a call that we are going to sell and not touch this stock again.
Check in on some of the movers then on Friday's trading session within the broader markets and get some technical takes on it. On the downside, you had something like a REITs which cracked about 5%. There was also JK Tyre that came under acute pressure, along with Westlife at about 738. Kunal, your views?
So I think tire stocks in the last couple of days have seen a bit of a backseat, but there's no major change of trend for the tire names. I think Apollo Tyres still remains to be the stronger name from the entire pack. So I think that's a stock which I would look to track more consistently, because that's a stock which has held up quite consistently above the 350, 360 levels. So I think that's a good support zone for Apollo Tyres. Much better bet than JK Tyres. Westlife, on the other hand, the stock has gone through, I think, a 2 days of correction. Prior to that, it's gone to a time-wise correction. So no major change of structure for Westlife. The stock has come back towards 735, 740 levels. It's much above its previous lows of 680, which the stock had hit in the fag end of the month of April 2023. So I think from that regards as well, the stock has upped its supports by almost 8 to 10%. So I think on both these aspects, these stocks look to be getting into a couple of days of correction, but the chances of supports being held on to these stocks at current levels would be far more higher.
Naresh, just get in a quick take then as to what the outlook is on the charts of some stocks that were shot up above their 200 DMA, RBL Bank as well as Oberoi Realty.
So RBL Bank has been going sideways, drifting lower after that move to 180 plus levels. But the recent lows around 135 should act as a support. So for now, the risk reward is not great for a short. The correction has already played out. 135 is the major breakout also of last year. So from here on, I would expect a bounce back. And given the case, what has happened with the rest of the banking names, we've seen recovery one by one in a lot of mid-cap, small-cap banking space. RBL Bank could also surprise on the upside. So I would rather wait for a time when the prices confirm an upside breakout than to buy the supports here. So once it sustains above 155, that would be the point of time I would like to go long rather than look at a trade as of now. So for now, expecting it to hold 135, 140 levels, and then eventually once it breaks 155, would be interesting. Oberoi Realty saw a move which was a little odd, given that it saw a big spike and then after the spike, the next 3 sessions were actually down. Gets back into the same range. The stock has been around that 900 plus minus 15 points for the last almost 6 months. So technically, no trend out here over the last 1 year, 1.5 year also, it has been around that 900 plus 50 points. So no clear trend, would wait for some trend to change. As of now, no view on OpenAI.
Rani is ready. Let's connect with him and understand that what should one do with Zomato. And Karan, I've got two reports. One is upgrade. The second one is price target has been maintained. Post Zomato, do you think in the near term the stock deserves a re-rating?
Hi, good morning. I think from Zomato's standpoint, it is a very good execution as far as profitability is concerned. If you look at the contribution per order in terms of number, we are now somewhere approaching towards the peak of pandemic levels, right? It was around 21 rupees that time on a per order basis. So from a profitability standpoint, there are levers around take rates, there are levers, around discounting basically coming down, and also the marketing revenue that they would make. But the problem here is in terms of growth rates. I think the re-rating for the stock will only come if the growth rates, sustain beyond that 20% kind of a number. And if you look at this quarter specifically, the growth rates were about 12% on GOV. Obviously, the two reasons for that. One is, the shutdown in 225 cities that they had. And second reason was also the inflationary pressure and also the overall QSR industry kind of struggling to grow as compared to what they were last year because of inflationary issues. So I think if the growth rates, on a steady state, sustain the range of 20-25% with healthy improvement in profitability, only then, we could see some sort of re-rating. But if growth rates are, 15%, 18% kind of a number, I think, there'll be no re-rating on the stock and the stock will be in a narrow band from now.
What do you make of the drop which has happened in the GOV? I mean, one side, Zomato was always a promise of growth and the fact that Indians will order more food and it is going to be food delivery business which will see exponential growth. That core growth now seems to be getting challenged and it's happened for 2 quarters on the trot now.
Yes, absolutely. I think, if you look at, there's a base implication here. So if you have to really chase profitability, you need levers, right? Now, there is no lever in terms of average order value because that's the biggest lever. So India as a market is price sensitive, low order value nature. So once you expand, you see a reduction in terms of order value. So I think what they are doing right now is that they're not focusing in too much of expansion. They're not focusing in terms of driving a large sort of a new customer base. The bigger lever here right now is retention and increased frequency, right? So I think that's the risk here. So if you actually only focus on existing customer and drive frequency within them, you will actually not see growth rates which are superior, 20-25%. Second thing also you have to look at is that the performance of the QSR companies. So many of these QSR companies right now in terms of SSG growth rates, the numbers have come down from a range of 7 to 8% towards 4 to 5% for some of these companies. So they are clearly seeing pressure. We are seeing a scenario wherein the base has kind of reached a respectable level, and even the delivery SSG, for some of these chains like Westlife and KFC, which were very small in the pre-COVID era. Now in the post-COVID era, for most of these companies, 35% of the revenues does come from delivery. So I think there is a catch-up which is playing out. There is a base impact here. And there's a clear dilemma for a company like Zomato, whether to chase profitability or whether to chase growth. And that's the point here. So valuations right now are at, 40 times EV/EBITDA F25. But potentially can it move to 50 times? That really depends on two reasons. One is, of course, the growth rates coming to 25% plus kind of number. And second is profitability. Now, again, in terms of profitability, they have done a very good job. Execution has been phenomenal. But going ahead, what are the levers, right? I mean, I don't foresee take rates increasing by a big margin. And how much can you pull discounts? If you keep pulling discounts, you're going to see an impact in terms of growth rate. So I think any kind of indication of, take rates seeing a blanket increase across the chains and growth rates being 25% plus are the triggers for re-rating here.
Karan, we were just chatting before you came on board as to how Swiggy is actually seeing markdowns, but here you have Zomato, where at least it seems that the worst is behind. Would you then upgrade your price target or at least keep it on your radar for Zomato?
I think I would not upgrade it for now. It would keep it as a hold because the primary reason here is that, of course, one is most of these companies have seen a markdown in valuations. and that's primarily do with the growth, right? I mean, most of these companies in terms of growth rates were around 30, 35, even 40%, and on a normal state. Now it's come to more than 20, 25% kind of a range. So there's a clear issue in terms of growth. So I don't see any potential for re-rating. Plus, I think if you look at Zomato, there's also this issue of Blinkit, right? The quick commerce segment today is making a hefty loss. I think 800,000 crores is the annual EBITDA loss is what they are making. So you also have to monitor in terms of where the losses are heading, because the core food business might look reasonably attractive at 40 times EV EBITDA. But once you include the losses of this business, your valuations go, 53 times EV EBITDA. So that makes it expensive. So I think I'll also monitor in terms of what happens to Blinkit, what is the kind of turnaround they are doing there. The kind of numbers they are doing right now, it's at a very small scale, about 40 million orders, which is very small. So one can't gauge in terms of what is the actual path to profitability here.
All right, appreciate your time, Tarun, and thank you for joining us. There are two numbers which are standing out for me, and one is Kochi Shipyard. Kochi Shipyard is this defense company, and it just got completely re-rated because what's happened in defense companies. Profits are down 85%. EBITDA is down from 296 crore profit. There is a loss, and revenue is down by about 50%. Sandeep, Cochin Shipyard, I mean, these are companies which essentially have got large order book, and there is so much of cyclicality in them. Then I'm actually amazed that for the quarter gone by, revenue is down 50%, profit has become a loss, and EBITDA also, profit is down 85%, and EBITDA has become loss.
Yeah, the main reason, Nikunj, is that the huge, long gestation period of most of their projects. So most of the analysts get excited when the order is announced, but they don't realize that designing process itself will take so long. The execution might start after 3 years, and deliveries might be after 5 years for many of these projects which companies like these shipyards are doing, or also a company like Hindustan Aeronautics, etc., are doing. So I think investors need to keep that in mind before buying their stocks, not immediately extrapolate orders into profit projection. And longer term outlook for most of them still seems to be good, but then many of the stocks have run up so much that they seem to be priced for perfection.
Not be tempted to buy into any of the defense stocks irrespective of where the price is. Sandeep?
You're asking me?
Yeah.
Yeah. So among the best listed companies, I think Bharat Electronics came out with decent results. So I think that's something which we have also accumulated, and I would be positively inclined towards that because that's where there is some valuation comfort. In terms of the sheer positivity of growth outlook, Hindustan Aeronautics stands out because of the magnitude of orders they've been giving. So that's something one can accumulate on every dip.
BEL, they've managed to meet their FY23 revenue guidance as well. The margins have come in at 28.3% versus 24.9% on a year-on-year basis. So good set of numbers from BEL. That's the stock that I'm talking about. That will just come off for you on your screens. Bandhan Bank as well came out with its earnings. We're going to be chatting with the management as well in the due course of the show. And their FY24 loan growth guidance stands at about 20%. The target NIMs are at about 7 to 7.5%. Sandeep, we've seen some outperformance sporadically, although in some of these smaller banks, but wanted to understand from an investment perspective, are you willing to draw down the list from the large cap banks right now?
Aisha, it's very tough to track all these banks, the smaller ones, etc. So I think for some people who are just focused on the financial sector for investments, they can do that. But I think given the way I see the economy, the rate environment, the liquidity scenario, etc., I would be sticking to the larger banks per se, like ICICI, Axis, etc. On the banking side, on NBFCs, we have exposure in Mahindra Financial, where we believe the NBFC is doing quite well.
So Mahindra Financials, Sandeep, weren't great. I mean, the stock is up 100%. Numbers were not that great. Do you see volatility could come back for that stock?
Volatility could come back if poor monsoons, if there are poor monsoons, which we don't know, and that leads to some sort of rural distress again, and then they get into the same NPA cycle which they got into a few years back. So I think that's the risk with Mahindra Financial. X of that, I think they have restructured their systems, the growth paradigms, etc., quite well. And to that extent, I don't see that risk.
I want to go back to Siemens once again. And why am I going back to it? Because I don't know what they've done. I mean, you've taken the business out and transferred it to the parent at a P multiple of 15. The current P multiple of Siemens based on FY25 estimate is about 55. The company is calling it non-core business, but guess what? This business, which they've hyped up to the parent, is a strong business both in terms of generating free cash flow and also in terms of the total contribution. So why would they sell the low voltage business at a P multiple of 15 times, which accounts for nearly 7% of the total sales, 9% of the total EBITDA, and that business has been transferred. Sandeep, we've discussed this one, but unfortunately with Siemens, every 3-4 years, they end up doing something which just raises concerns about do they really care about minority shareholders?
Yeah, that's true. And that's what I said, that every few years there is one such event. What leads to that? So there's complete lack of transparency around it, and that becomes a concern. For a long time, this was no such thing happened, and the growth outlook also improved so much that the stock got extremely re-rated. So I think this could raise some concerns in the near term.
Bunch of other stocks which are going to be in focus. We just highlighted Bandhan Bank. There's Muthoot Finance as well, wherein the gold AUMs are up 7.5%, and the NII has also risen at about 7.74%. So that's another stock which is going to be in focus. Divi's has actually come out with a decent set of numbers. They've managed to beat the street estimates. Sequentially, the margins have come in at 25% versus a comparable of 23.9%, and the Q4 revenue as well has come in above estimates. So that's another stock which is going to be in focus. But talking about Muthoot Finance, Kunal, it's inevitable when there is any note ban, you think about whether the demand for gold is going to see an uptick or not. And I think over the weekend, it's already hit 60,000 plus levels.
Yeah.
What do you read on the charts?
So I think gold has hit that 62,000 mark. Rupee terms, I think silver went to 74,000, 74,500 the last I remember, clearly on the MCX. But again, the charts, in fact, for gold and silver, the only tricky part is that the global charts for gold and silver are on a negative downtrend. In fact, gold on dollar terms, if I remember clearly, I think last week or so hit a 7-month low in the last week or so. So I think that also indicates that gold prices across the globe are going into a bit of a correction. So this may be a temporary rise which could happen for gold prices. I think the settling range in terms of rupee terms would be at 60,000, 60,500 mark for gold prices. So maybe we may see a short-term spike, but I think the mean for gold prices in rupee terms is at 60,000 levels or maybe slightly below that.
Nikunj, tell me, which is that one commodity which is at an all-time high?
Certainly not coffee, I can tell you. All-time high.
Kunal knows the answer.
Gold should be nearing an all-time high.
No, it's olive oil.
Oh, yeah. Indians are consuming
Right,
more olive
Kunal?
oil.
Yeah.
Olive oil?
So I was reading some article that there's some drought in Spain or something of that sort, and that's why 40% of the production which happens over there, and that's come down significantly. So the price of olive oil has gone up.
Well, you live and you learn.
Yeah.
So back to groundnut oil for your health cooking freaks, everybody.
Aman.
No olive oil this time.
No olive
Back to
oil, I
groundnut
guess.
oil.
Not gonna lie. Yeah, so Sandeep, I don't know what you're doing if you're switching up your cooking oil alternatives. No.
He doesn't cook. It's okay,
But
don't ask
he
him.
eats.
He doesn't know what his wife is using. I can guarantee on that. He doesn't do. Do you know what oil has been used in your kitchen?
Yeah.
Oh, no. Come on, it's okay. You're national television. It's okay if you don't know.
No, I know.
Is it olive oil?
Yeah, it's olive oil. It's not virgin. It's not extra virgin. It's a virgin olive oil, which is good for Indian cooking.
A few tips about oil since we're talking about it. Never reuse oil.
Yeah.
If you heat it once, if you reheat it again, it becomes poisonous. Always stick to a good brand. Vegetable oil may sound very fancy, but trust me, vegetable oil is a process in which a lot of minerals actually are filtered before it becomes crystal clear. Yeah. So go back to basics, you know that grandmama style?
Yeah.
Groundnut oil, sesame oil, cold press. I think that's what works in India.
You surely know what oil is being used at
No,
your
it's
kitchen.
just that you need to be aware of what you're actually consuming. I mean, ultimately.
You are what you eat. You are what you eat.
Exactly, that's Sadhguru. Your body is what you eat, your mind is what you think. Very simple.
Okay, from markets to looking after your health, we tell you pretty much everything. Okay, so let's get right back to the markets. Those pre-open rates around the 18,100 mark. We're on the back foot, down 0.5%. Mid-cap strategies then. So Naresh, we're not going to ask you which cooking oil you're using, but we'll ask you what your mid-cap trades are.
So that would be a buy on NIIT Limited. That's a stock which has finally given a breakout after months of consolidation. We've seen Aptech hit a new all-time high. Now, if you look at NIIT Limited, yesterday was a 5x volume bump up. The stock has given a short-term range breakout above that 380 mark. Expecting this to continue with a follow-up towards 450, 500 levels. A stop loss to be placed at 370.
Okay, there you have it. NIIT, target price 450. What about you, Kunal?
So I'll go ahead with a buy on Samvardhana Motherson. That's a stock which we tracked earlier at 66, 67 levels. It's now moved up to almost 80 plus mark. I think on Friday it hit levels of 80, 81. Looks very attractive. Momentum extremely strong. The stock has filled a major gap which it had created almost 3-4 months back when it had fallen below 80 levels for itself. So buy on Samvardhana Motherson, targets of 86, stop loss at 78.
Okay, let's also tell you what else has been making news. And the RBI governor is set to take stock of governance concerns at PSU banks. In fact, sources say that Governor Das will be meeting directors of PSU banks today to cover issues related to functionalities and ethics of banks, including supervisory expectations. Also, after completing a successful Japan visit where he attended the G7 meeting, Prime Minister Narendra Modi is now in Papua New Guinea as part of his three-nation visit. Upon arrival, PM Modi received a rousing welcome in the country, and the Prime Minister, James Marape, greeted PM Modi at the airport and even touched his feet to show his respect. Also back home, heightened security in the valley ahead of the G20 meet. Authorities have issued an advisory for the public amid G20 meet, which is scheduled for today and tomorrow, and suggested alternative traffic movements for the ease of the public. Forces are keeping an eye on all sensitive and hypersensitive locations in the state. And also Saudi Arabia's first astronauts in decades rocketed towards the International Space Station on a chartered multi-million-dollar flight on Sunday. SpaceX launched the ticket-holding crew held by a retired NASA astronaut now working for the company that arranged the trip. Also on board, a US businessman who now owns a sports car racing team.
Meantime, the state funeral of the Queen Elizabeth II cost the UK government close to £162 million. The Treasury has said that, given out those numbers. The UK's longest-serving monarch, remember, died on the 8th of September, age 96, at Balmoral Castle in Scotland. Meantime, social media platform Instagram is back up and running. This after there were technical glitches which disrupted the services for thousands, or should I say millions of users late last night. The outage was spread across countries like the US, Canada, as well as Britain. Meantime, in a thriving display of sport, Virat Kohli's knock of a century was not enough to push the Royal Challengers to make it to the playoffs, as Shubham Gill outdid Virat Kohli, scoring his own set of back-to-back centuries. RCB's loss led to the Mumbai Indians qualifying for the playoffs. Gujarat Titans will now face Chennai Super Kings in the Qualifier 1, and Mumbai Indians will now face Lucknow Super Giants in Qualifier 2.